This is an RNZ podcast.
Money matters can seem complex and confusing, but they don't have to be. I'm Jesse Mulligan, and every fortnight on afternoons on RNZ National, personal finance whiz Mary Holm joins me to talk about what to do with your money. It's a straightforward and jargon-free conversation. I'm Jesse Mulligan, and you're listening to an episode of Your Money with Mary Holm. We're talking investing in shares today.
Yes, yeah. And you and I were just saying, given what's happening to the world at the moment, you wonder how that's going to affect shares. And the answer is nobody knows. But it's the same old advice as ever. Don't panic and move your money. I mean, so far, share markets haven't plunged, but it's so hard to know what might happen in the short term.
Yeah, but lots of people out there who maybe scared off shares in the late 80s and then have been following over the last 10 or 15 years and thinking, actually, I might be missing out here, might be wondering where to begin.
It's a really interesting trend that, yes, as you say, in the 80s I was the business editor of the Auckland Sun, and I can still remember someone yelling across the newsroom, Briley, shares have gone down to $2.
Oh.
And it wasn't just the business section that was sort of saying, wow, It was the whole newsroom, because in those days, everybody was invested in Briley shares. And after that 87 crash, which hit the world, but it hit New Zealand harder than I think any other country, a lot of New Zealanders got put off shares forever. And so quite a few people who were around then aren't doing it. But we're now seeing young people saying, well, I think possibly watching how much people have made in individual shares, often IT-type shares, American IT industry shares. And so there's a lot more people taking an interest in it now. And I've just got a couple of warnings about it. I don't think people should not do it, but I think they need to keep their eyes open.
Okay, where shall we begin?
Well, noting perhaps that when people say they're doing really well with their share investments, firstly, they might be very lucky. I mean, there are some people who are very lucky, and they're the ones that make a big noise. Secondly, a lot of people who say to me, look, I've invested in a range of shares over the years and I've done fantastically. But if you look at it, they haven't done any better than share funds in and out of KiwiSaver, which is what I think tends to be a better thing to do. But having said that, getting into individual shares, so shares in individual companies, it's like a hobby. And my father used to do it and he loved it. He took a great interest in which companies were doing well and what was happening in the markets. And there's nothing wrong with that.
It doesn't count as a hobby if you've got your life savings in there, though.
That's right, yes, unless they're real well diversified and all of that. I'll give you a few rules at the end here, cool. but that's right. It works better as something with 5% of your savings, 10% of your savings, something like that. To put that into shares if you want to.
If you're going to play around with them yourself and buy and sell. And,
yes.
Yeah, if you enjoy that part of it.
Yeah.
As long as you sort of come to terms with the fact that you might not end up beating the market.
Yes.
And likely won't.
Yeah. But you might. Yeah. And look, there's a gambling element in it, of course there is, which, can be quite appealing.
Yeah.
Somebody was saying to me, well, which brokers should you go with? And I don't know. I mean, some of the ones that we hear a lot about are the newer, relatively new ones, Sharesies and Hatch. But then there's ones like Craig's and ASB, and then there's some old brokers around whose names have been in the markets forever, and I don't know which ones are best. There must be comparisons online for people if they want to look at that. It would depend on what sort of service you want from the broker, and I mean, some of the brokers will give you regular information on individual shares, and others leave you to do the research yourself. So, and by the way, if you do want to put some of your KiwiSaver money into individual shares rather than into a fund that holds a whole lot of shares, there are, I've been doing a survey recently of KiwiSaver providers for a book I'm writing, and Craig's and Sharesies have both got KiwiSaver schemes, and in those you can invest your money in, one particular company.
Really?
But not all of your money.
Uh-huh.
No, I think they've got limits of like 5% of your money. I'm not sure exactly, but you can go into individual shares. Then there's another one called Kiwi Wrap, but you've got to do that through an advisor. So there's a few of them that do that, but generally speaking, in KiwiSaver or in a wide-ranging fund. But I've got first of all, I've got 4 reasons why it's not a great idea to be going into individual shares, and then later I've got 4 things to do if you insist. So the 4 reasons that you might not particularly want to do it versus, say, putting your money into a share fund that holds a whole lot of shares. Because I should just say here, I think shares are a great long-term investment. But the reasons for perhaps not getting into individual shares are, firstly, you've got to keep track of dividends, stock splits, tax, all of that sort of stuff. There's quite a lot of admin involved in running your own shares, whereas if you're in a fund, it's all done for you. The tax and any other dividends and all of that are reinvested in the fund. It's all done for you. Secondly, if you're investing in a fund, you're going to actually get the same average returns as people investing in individual shares get, but with less volatility because when one share goes up, another one goes down, and the data all show that. I used to run a stock picking game for university students when I taught a course at University of Auckland, and the students had to pick which shares they were going to do well with, and that always showed that they were better off in a wide range of shares than in an individual share, 1 or 2 individual shares, because they're still going to get the same average return but with less volatility, which is, yes. The third one, which a lot of people don't really realise, is that most shares perform worse than the share market indexes. And you think, that doesn't make sense because the index is kind of the average of the market. So you would think half the shares would perform better in a given year and half of them would perform worse. But a lot of data shows that that's not true in New Zealand and America and in the world. And that's because you might get, say, 3/4 of the shares in a market index doing worse than average and 1/4 doing exceptionally well.
Yeah.
And so that's what sort of, they pull the average
happening in the
way
US
up.
at the moment, isn't it?
Yes, yeah.
Those
But
big tech stock, big AI stocks. Yeah.
that's what has happened in America. Whether that continues to happen is totally open to debate. It very well might not. The shares that have done particularly well quite often don't do well after that because they've been oversold. People have got too enthused about them. And finally, you and I can't beat professionals at picking shares. I mean, the professionals, the ones that run the share funds, etc., they don't tend to do all that well anyway on average. A lot of them don't do well. And you and I, thinking that we can read an article in the paper or go online and actually crunch the numbers, but we're not going to beat the professionals to do it. And if we don't beat them, if a company is looking as though it might be doing really well, then suddenly looks as though it's going to do really well, then the professionals are going to get in right away and buy that share. And you and I are going to get in the day after, and by then the price has gone up, and so it's not a good buy. That's a basic message, that buying into a company that's doing well, performing well, doesn't necessarily mean it's a good share. An interesting example of that was when I was doing the stock picking game with the students, and a whole lot of them at the beginning of the term chose to invest in Fletcher Building. That was because the Christchurch earthquakes had just happened.
Yeah.
And they said to me, look, surely this company's going to do well in the near future. But probably the price of Fletcher shares went up the day of the quake. This was a couple of weeks later. They were already too expensive, and those shares actually came 20th out of 25 in the game that year. It doesn't just because a company looks as though it's doing well or is doing well doesn't mean the share price is a good buy.
Probably priced in already.
Yes. Exactly. Now, one exception to all of this is employee share schemes. Sometimes companies that you work for, if they are a company that's listed on the stock exchange, will offer you cheap shares. Go in and get those. It's always a good idea to get those because they're below market price.
Mm-hmm.
So quite often you have to hold them for a year or two before you're allowed to sell them. But so get in, buy them, hold them, and then sell them, and you'll usually make a gain. But that is an exception to what I've been saying here. So I would say, in general, my message is use share funds. You don't have to be in KiwiSaver. You can be outside KiwiSaver and still put your money in a share fund. And that way it's a heck of a lot easier. The admin's taken care of for you. You're going to get less volatility for all kinds of reasons. But having said all that, there are going to be people listening to this who say, no, I enjoy being in the market, picking which shares. And I'll say, okay, cool. My dad was like you. So there are a couple of suggestions I would make. One is, if you're doing that, get your dividends reinvested. So the company's paying you dividends. Quite a lot of companies will let you automatically reinvest the dividends in buying further shares, or you can do it yourself. That's the way to get good, solid, long-term returns. Please diversify across different industries, across different countries. Don't think that, okay, you're investing in New Zealand shares, you'll go over to Australia and buy some of those and that gives you international diversification. It's a little bit better, but it's better to actually be in shares from all around the world. Mm-hmm. And these days, through I know that brokers like Hatch, but quite a lot of others will let you go into, within New Zealand, will let you go into shares from all around the world. Don't try to trade often. Don't be looking at the market and saying, oh, look at what's happening to Iran, I'm going to sell, or I'm going to buy shares in this industry or that industry. There's heaps of research and it keeps on finding the same results, that those who keep trading don't do nearly as well as people who get in and stay there. So finally, you really need a 10-year horizon. If you're going to get into shares, get a wide range of shares and hold them for at least 10 years.
Great. Thank you, Mary.
It's a pleasure.
Thanks for the info, Mary's guide to getting into shares. And if you came in at the end, you'll be able to find that on our website on demand.